Good evening. Come to this wonderful standard, IFRS 9 again. So, our topic today will be accounting of financial assets, FVTPL, FVT, OCI, and amortized cost. How to identify a fair value through profit and loss account instrument. Okay, if it is a debt instrument, then it should not be FVT OCI and it should not be amortized cost. How to identify amortized cost? It should satisfy contractual cash flow test and it should satisfy business model test 1. That is, the objective is to collect the entire cash flow, not to sell the asset. And how do you identify FVT OCI debt instrument? Contractual cash flow test and business model test 2. The objective may be to collect the contractual cash flow or to sell it also. And if it is not either of the two, then a debt instrument will be FVTPL. Second, a debt instrument will be FVTPL if the objective is to held for trading. Objective is held for trading. Now what about equity instrument? An equity instrument also held for trading, FVTPL. Or if the management has not designated it as FVT OCI, then again the equity instrument will become FVTPL. A derivative instrument, future forward option swap, will always be treated as FVTPL. Okay. So what is a held for trading instrument? All held for trading instrument will be treated as FVTPL. The objective is to purchase it and sell it in the near term, near future. Or on initial recognition, it is a part of a portfolio of identified financial instrument that are managed together and for which there is an evidence of recent actual pattern of short-term profit taking. It's a part of a portfolio. This is the financial asset. It is the part of a portfolio, and this portfolio has the history of short-term profit booking. So then also this instrument is treated as held for trading. It's a part of a portfolio and the portfolio is managed for short-term profit booking. Or third, it is a derivative. Derivative is assumed to be held for trading instrument, except for a derivative that is a financial guarantee contract or a designated and effective hedging instrument. If a derivative is used for hedging purpose, then in this chapter there are special rules called hedge accounting rules. Okay, and that time the derivative will be accounted as per the specific rule applicable for hedge accounting. An entity may, now see this paragraph, the management, entity means the management, is given a big power in this standard that you can designate any instrument as FVTPL, even though it may meet the definition of FVT OCI, okay, or amortized cost. Okay, so even if a debt instrument, for example, fulfills the definition of amortized cost or FVT OCI, can the management voluntarily designate it as FVTPL? Yes, but this is irrevocable. That is, you cannot change the definition later, change the classification later. Why will a company do that? Why will a company which should be designated as amortized cost will be designated as FVTPL? This is done to avoid accounting mismatch. This is done to avoid the accounting mismatch. What do you mean by accounting mismatch? So for example, how do we do business? We take loan, we give loan. Suppose this is the business. Loan taken is a financial liability. Loan given is a financial asset. Now suppose if this is measured as FVTPL, fair value through profit and loss, and the loan if I measure at amortized cost, there will be an accounting mismatch because this loan is taken to finance this asset only. Okay, here I am going to recognize the change in fair value in P&L account, but here I am not recognizing the change in fair value to P&L account at all. It is measured at cost. So the profit and loss account will be volatile, accounting mismatch. So what you will do, instead of classifying it as amortized cost, why don't you classify this also as FVTPL? So what will happen? If there is a loss in this instrument, it will be compensated by a gain in this instrument. Is it right? Because one is the asset, the other is a liability. So if the interest rate goes up, the value of your asset and liability both will decrease. So loss in asset, gain on liability. If interest rate comes down now, value of your liability and value of asset both will go up. There is an inverse relationship between the market rate of interest and the value of a debt instrument. So there will be a loss in asset, gain on liability. Okay, so it helps you to avoid accounting mismatch. But remember, this is purely voluntarily. You can designate an instrument as FVTPL on your own. This is done usually to avoid accounting mismatch. Okay, or for example, you have a financial asset, and in order to protect the value of that financial asset, you have taken a derivative. I don't want to go into derivative in detail right now, but still, this financial asset and there is a derivative. You have just now learned derivatives are measured as FVTPL. So for derivative, there is no problem. But if I measure the financial asset at amortized cost, there will be an accounting mismatch because the gain or loss in derivative will be transferred to P&L account, but the change in fair value of this financial asset will not be transferred to P&L account. But the objective of this derivative is to protect the value of this asset only. What the company can do, it can change the classification of this to FVTPL. So now what will happen? If there is a loss on derivative, there will be a gain on the financial asset. If there will be a gain on derivative, there will be loss on financial asset. So it will protect the P&L account. So it will avoid the accounting mismatch. So that can be done. Is it right? Once you choose this option, it is irrevocable. Investment in equity instrument will be treated as FVTPL unless the management decides to treat it as FVT OCI. When will management decide to treat it as FVT OCI? Normally, when it is a strategic investment. Okay. And if you don't designate it as FVT OCI, then FVTPL. Equity instrument, only two classification. Either FVT OCI or PL. If it is not FVT OCI, FVTPL. If it is held for trading, FVTPL. Okay. Fair value through profit and loss account. Now see the accounting. Day 1, you have acquired a financial asset which is designated as FVTPL. So on the day one, it will be measured at fair value. Okay, fair value meaning is given in IFRS 13, fair value measurement. Normally, fair value would mean the market value if it is quoted in an active market. Otherwise, there are other ways to arrive at fair value. Then subsequently what you will do, gain on loss that arise as a result of change in fair value will be recognized in profit and loss. Very simple accounting. Day one, financial asset account debit to bank at fair value. If there is a difference between fair value and transaction price, P&L account. If you have incurred any transaction cost for this asset, yesterday we have discussed, P&L account. Subsequently, the value goes up. Asset, financial asset to P&L account. If the value falls, P&L account debit to financial asset. Okay. Only this rule will not be applicable for derivative which are used for hedging purpose, and the entity follows the hedge accounting rules. About hedge accounting we will discuss later. So this is a small and quick summary of what you will do for FVTPL instrument. No need to write, printed there. Initial recognition, FVTPL assets will be recognized at fair value. Transaction cost, transfer to P&L account. Then on each reporting date, the instrument will be again remeasured at fair value, because my objective is to make profit from this instrument. The difference will be transferred to profit and loss account. That is why the name of the instrument is fair value through P&L account. So the difference will be transferred to P&L account. I have written one entry. Suppose the fair value goes up, increase in value. Financial asset account debit to profit and loss account. Then I have written a note for you. Reverse the entry in the case of decrease in value. So the entry will be P&L account debit to financial asset. On settlement date, whenever you are going to settle that instrument, you again measure it at fair value on that day, and the difference will be transferred to P&L account. So derivatives are usually settled. So this line we will be requiring for derivative. When you will settle it, again check the fair value on the settlement date, transfer the difference to profit and loss account. On sale, again the difference between the carrying amount on that day and sale proceed will be transferred to profit and loss account. If at the time of sale also you incur any transaction cost, transfer it to P&L account separately. Any dividend income will be recognized as income when the right to receive the dividend is established. Okay. Right to receive the dividend is established when the dividend is properly declared by the respective authorities. In case of final dividend, the authority is AGM. In case of interim dividend, the authority is the board. So once the dividend is properly declared by the necessary authority, then you will recognize the dividend in the income statement. Just for any clarification of doubt, in IFRS we do not differentiate between dividend out of pre-acquisition profit or dividend out of post-acquisition profit. All dividend will be transferred to profit and loss account. It's an income because we are recognizing the asset already at fair value. Is it right? So subsequently any income will be recognized in profit and loss account. Example of FVTPL, non-derivative instrument like share, debenture, derivative instrument like future, options. Now we'll take 2-3 questions on FVTPL. Very easy because there is no major calculations involved. Every time you have to just increase or decrease the fair value. Question number 8. Date particulars rupees. 7th February 2018, purchased 1 share at 709. 31st March 18, year end date, fair value is 740. 14th April 18, sale of share at 750. So pass the entries below. First you will buy the share, and if it is a share and if nothing is given, you can assume FVTPL. For equity share, if the problem is silent, we can always assume FVTPL, and it appears from the problem also. They purchased it in February and sold it in April, right? So first entry will be purchase entry, 7th February 2018. Investment account debit to bank account 709. Investment account debit to bank account 709. This is the entry for purchase of share. And then we'll come to 31st March 18, year ending date. The value of the investment has increased from 709 to 740. Gain or loss? Gain. How much? 31. Entry. Investment account debit to profit and loss account. 31. Being revaluation of investment recognized in profit and loss account, and then we will sell the investment on 14th April 2018. Write in good handwriting. Bank account debit 750 to investment account 740 to P&L account 10 rupees. Okay, that's it. Try one more. This time I will give you a debt instrument, but that process is same, don't worry. In addition to usual entry, also pass entry for interest. On 1st April 20x1, ASF Limited bought 6% 1000 bonds of ABC at rupees 85, maturing on 31st March 20x6. Bonds to be valued at FVTPL. So now they have given you instruction. So do not apply your own intelligence and try to find out what is the classification. Respect the question setter. FVTPL. Market rate on 31st March 2002 is 89. So if it is FVTPL, my main objective is to make profit by trading, by selling. Is it right? And of course, in addition, you will earn some income also. That also we will account for it. Show the journal entries. Carrying amount in SOFP, Statement of Financial Position, and presentation in SOPL, Statement of Profit and Loss. So you will also see how it will be presented. Is it right? So dear student, write 1st April 20x1. Write yourself in the book itself. Is the entry printed? Oh, wonderful, amazing. In the exam, they will not give you like that, okay? We have to just save time. So basic problem, I have given some format. Investment account, you can write the name of the investment, bonds carried at FVTPL. Is it right? Debit 85,000. How this 85,000 has come? 1000 into 85. Write in bracket 1000 into 85. To bank account 85,000. And then you are also going to receive some interest income on that. In FVTPL instrument, income received, you transfer to P&L account, SOPL. So how much interest you will receive? 1000 bond. What about the face value? 100 rupees. So take on your calculator 100 into 1000 into 6%. Is it 6000 rupees? Write calculation. Afterwards, don't ask me. I'll charge you 100 rupees for this. 1000 into 100 into 6%. Written? Yes. In bracket, write SOPL. So that, or you want to pass one more entry for transfer to P&L account separately. Then interest income to P&L account. One more entry if you want, or you write here only. Focus on understanding. Then we will go to 31st March. Now we will value the instrument at fair value. What is the fair value of the instrument on 31st March? It is 89 rupees. And at what rate we had bought it? 85. So we are gaining 4 rupees per share per bond. So calculation also I have written 1000 into bracket 89 minus 85, 4000. So investment account, same name you will write here. Whatever name you will write here, you write again to P&L account. Okay. And the narration will be unrealized gain rupees 4000 transferred to SOPL. Okay. And then you write the presentation in the statement of comprehensive income means SOPL part 1. So it will come as other income. Interest income 6000, right? 6000 interest income. Unrealized gain on bond measured at FVTPL 4000. Okay. And how will you present that in the balance sheet? So in the balance sheet, you will write, this is basically for trading purpose. As you can see, it is FVTPL. So we'll show it as current asset. We'll show it as current asset. Under current asset, we will write financial asset. And under financial asset, we will write investment in bond, FVTPL. 85,000 was the purchase. 4,000 is the increase in value. So write yourself 89,000. Write 89,000. Written 89,000. Yes. Now we'll make little more complication in the problem. Is it right? Come to question number 10. Is the answer also printed? Close the book. Close the book, huh? Only on the screen. On 1st April 2020, ASF Limited bought 1000 equity share of B Limited at rupees 30. Okay, stamp duty is 0.50 per share and commission on purchase is 0.30 per share. Equity shares are to be valued at FVTPL. Market rate on 31st March 2021 year end is 35. Show the journal entries and carrying value in SOFP and SOPL. Presentation in balance sheet and statement of profit and loss. So now in this question, be careful. These are transaction cost. Instrument is FVTPL. So it will be separately accounted and transferred to profit and loss account. So investment will be initially valued at 30 rupees only, not 30 plus this transaction cost. Why? Because in case of FVTPL, transaction cost is recognized in P&L account. And then at the end of the year, the value of the investment will go up from 30 to 35. We will recognize the gain. So transaction cost we will transfer to P&L account. Fair value gain we will transfer to P&L account. And in balance sheet, investment will appear on the asset side, financial asset. Okay. So see the answer. First entry will be only on the screen. Investment account debit to bank 30,000. And on the same day, 1st April, transaction cost account debit to bank. How much will be transaction cost? 50 paise plus 30 paise. 50 paise is for stamp duty and 30 paise is for commission. 80 paise per share. 80 paise into 1000, 800 rupees to bank. And then at the end of the year, we will revalue the investment at fair value. Now the fair value is 35. 35 minus 35 rupees fair value gain into 1000. The investment in equity share FVTPL account debit 5000 to P&L account 5000. Narration being unrealized gain rupees 5000. Make a small correction. Unrealized gain 5000 transferred to SOPL. Transferred to SOPL. And then you will transfer transaction cost to P&L account. P&L account debit 800 to transaction cost 800. Being transaction cost transferred to SOPL. For this much effort, who knows, you will get 4 marks. And then statement of comprehensive income. Other income. Do we have any interest or dividend income in this question? No. Fair value gain we will write 5000 and part B expenses, transaction cost 800. SOFP asset side, if it is FVTPL instrument, we will show it as current asset because the objective is to sell. And financial asset, investment in equity share of B Limited, and the amount will be how much now? 35,000. 1000 share. Closing balance is 35. So 35 rupees closing fair value, so 35,000. So the counting of FVTPL instrument would normally be simple. Okay. Then where is the complication? Second part, amortized cost category. This is also not very difficult once you understand it. Now, amortized cost category will be used only for debt instrument. Cannot be used for equity instrument because equity instrument does not fulfill the contractual cash flow test. There is no contractual cash flow. So equity share, investment in equity share, you cannot do this accounting. When will you classify a debt instrument as amortized cost instrument? Following two conditions needs to be satisfied. One, it must satisfy business model test. And which business model test? The asset must be held in a business model whose objective is to collect the contractual cash flow. So whatever cash flow this asset will generate, your objective must be to collect all those cash flows. Of course, in extreme situation, you may sell it. Okay. But main objective is that I am going to hold it and I'm going to collect all the cash flows this instrument will generate. Will the change in the market value of the instrument affect it? No. Is it right? This is your bike on the parking lot. Market value has gone down. Will you cry? Say yes or no. No. Or you don't have to sell it. You have to use it till next 15 more year. Is it right? You'll collect all the possible benefit of that bike. So you are least bothered. So you'll measure it at cost, subject to whatever basic adjustments are required. Is it right? If the value of bike in the market goes up, what will you do? Sell. If your objective is to sell, then it is not amortized cost. You will use it. So you are not affected. Same thing for a debt instrument also, where the objective is to hold it till the maturity and receive all the cash flow. The change in fair value does not matter. So I am not going to give importance to change in fair value now. I am measuring it at cost. Second test is must satisfy contractual cash flow. That is the cash flow that will be generated by the asset should represent principal and interest. And interest will be based on 4 factors. 1. Time value of money. Credit risk, other risk associated with debt like liquidity risk. And 4th, a profit margin of the lender. Is it right? So if the interest represent these factors only, then we will assume that contractual cash flow test has been satisfied. I have written a note also to avoid any confusion. Amortized cost category applies only to debt instrument. that meets the specified criteria, amortized cost measurement requires the application of effective interest method. Effective interest method means IRR or EIR. So some knowledge of effective interest rate is required. Substance over form. What is the purpose of this accounting? Substance over form. So even though coupon rate may be 8%, coupon rate means contractual rate, but its effective interest rate may be say 12%. So I have to recognize at the rate of 12% in the profit and loss, and whatever I will receive will be treated as inflow received, will be reduced from the carrying amount of investment. Is it right? So cash flow received is like I am getting payment towards my investment, but my income will be effective interest rate multiplied by opening balance. So this gives me the effective interest earned on this instrument. Okay. Now again we have made a small summary of what you will do for amortized cost category. Okay. So day one accounting at fair value. Day one accounting at fair value like FVTPL. But if there is a transaction cost, it will be included in the carrying amount. Transaction cost will not be transferred to P&L account. It will indirectly get transferred to P&L account when you will be using the effective interest rate method. So that we will learn in one problem after this. Subsequent measurement will be at amortized cost. So cost subject to some adjustment. Okay. Accounting will be done through effective interest rate method. What is effective interest rate? Effective interest rate means IRR. It is that rate of discount which exactly discount the estimated future cash payment or receipt through the expected life of the financial instrument to the net carrying amount of the financial instrument. So it simply means the present value of cash inflow is equal to present value of cash outflow or carrying amount of the instrument, because year 0 it will be this equation, but after that it will be this equation. PV of cash inflow should be such that it matches with your carrying amount of the investment. So that is called EIR. Now one cross check in your answer is that on maturity the carrying amount will become equal to maturity proceeds. We are going to solve few questions below this. You will find that in the last year my book value becomes equal to my amortized my maturity proceed. That is what amount I am going to receive in the last year. Okay. If there are minor differences, you make adjustment in interest, because your effective interest rate IRR is a rounded off number, is an approximate number. Is it right? So some 2-3 rupees difference will come at the end, or some 100 rupees difference may come. What about change in fair value? Ignore. Change in fair value, even if they give you to test your confidence, ignore. Just like you ignore homework, ignore change in fair value. Change in fair value resulting from fluctuation in fair value are not recognized for financial asset classified in the amortized cost measurement category. I have told you the reason. I don't want to sell it. My objective is not to sell it. So therefore the standard says when you don't want to sell it, then keep your eyes closed from the change in the fair value. Is it right? Now what is amortized cost? Amortized cost of a financial instrument is defined as the amount at which financial asset or financial liability is measured at initial recognition. Okay. So first I will recognize at the beginning fair value, and then minus the principal repayment. Any principal repayment will be reduced, or minus, plus or minus the cumulative amortization. Now, what is plus minus cumulative amortization? It is the difference between interest received and interest earned. Now, what is the difference between interest received and interest earned? Interest received is calculated as face value into coupon rate, like in bond valuation you used to do. And interest earned is opening carrying amount into effective interest rate. If both are equal, then this portion will automatically be 0. But otherwise, so your opening balance minus any repayment and any adjustment for difference between interest received and interest recognized, okay, using effective interest rate method. And at the end of the period, once the entire life is over, your carrying amount becomes equal to maturity proceeds. Using the effective interest rate method of any difference between that initial amount and maturity amount, and for financial asset adjusted for any loss allowance. This loss allowance we will discuss later in impairment part. Today there is no impairment, okay? Basic problem. Now, to understand this amortized cost concept, first we'll take a very basic problem. This question is just designed for understanding the amortized cost method. And then we will make some modification in the problem, make it little more advanced, add more variables. Okay. So what is this question in front of you? It says A Limited issued 6% debenture of rupees 10 each. Sorry, of rupees 10 lakh at 10% discount, redeemable after 3 years at par. Prepare the debenture account. Now you can't prepare debenture account. In the exam, first we have to check what is the classification. If nothing is given, you have to apply your judgment, okay? So it is a debenture debt instrument. So it can be FVTPL. Normally avoid FVTPL category for a debenture or a bond. Okay. Then you can either treat it as FVT OCI or FVT or amortized cost. So right now we'll assume it to be amortized cost. Same problem can be solved by assuming FVT OCI. But I will not treat it as FVT OCI also. Why? Because the fair value will be given at the end of each of the 3 years, which they have not given. So now I can't apply FVT OCI also. Because to apply that I require fair value at the end of year 1, 2, 3, which they have not given. Therefore, this problem can be solved by using amortized cost category. Anyway, this way you have to take a call in the exam. Because to apply fair value, you need fair value. There is no fair value in the problem. So first you compute the effective rate of interest. Now why effective rate of interest is not equal to the 6% coupon rate which they have promised? Because this bond is issued at a 10% discount. So you are going to receive not 10 lakh, less than 10 lakh, but you are going to redeem 10 lakh. You are going to pay coupon on 10 lakh. So your effective rate of interest will be higher than the 6%. So dear student, first you write down one format. Write here one year 0. See, I am not good in finance. You help me. Calculation of effective interest rate. If not given, you have to calculate. First write down year, cash flow. Now you have learned IRR in your financial management subject. You have to assume, guess a rate of discount which may be IRR. Okay. So what rate of discount you will assume? First tell me, do you think it will be more than 6% or less than 6%? Vote for more than 6%. Oh, 100% vote. So which rate I will take? Take any rate which is little higher than 6%, because see, you are issuing at a discount. So when you issue bonds at a discount, your cost goes up. You have to bear that burden of discount. Is it right? You are getting 9 lakh and you are paying 10 lakh in addition to paying 6% interest. So that extra 1 lakh you are paying is going to add to your cost. So let us take 10%, 9 or 10%. 7 is also okay. There is no fixed rule here that you have to take 10 only or 7 only. Your choice. Discounting factor for year 0 is 1, 9 lakh. 1-3. You can take less than 10 also. I have no problem. 1-3 and 10%. Come on, little fast. 2.4869 into 60,000 coupon. 60,000, 6% of 10 lakh. 149, 200, 211. Round off the last digit, don't write in paise. Factor for third year. Is it 0.7561? Yes. 7513. Okay, 7513. 7513. This is a time consuming question because you have to compute the IRR. So start this question in the exam only if you know how to calculate IRR. Okay. So now my question is, what is the net present value? Take positive total minus 9 lakh. 500 and positive or negative? Is it positive? So we are close to 0 now. We are close to 0. So I will take 10%. I will take 11% now. So I will take one higher rate now. If it is positive, take a higher rate. Higher the discount rate, lower the present value. So my objective is to move towards 0. My objective is to move towards 0. So 11%. For year 0, 1, cash flow 9 lakh. And for 1-3, you will tell me. 2.4437 multiply into 60,000. 146, 620. For the third year, 0.7, 7312. 7,31,200. Again take the total carefully. Minus this 9 lakh. 2022. Positive or negative? So which means the IRR falls somewhere between 10 and 11%. The IRR will fall somewhere between 10 and 11. Is the calculation right? Everybody? Afterward the whole account will go wrong. Now, do you know the formula for IRR? Calculate whatever formula you have learned. So first we will write the start rate, the lower of the two discount rate, 10, plus the net present value at the lower discount rate, 511 or 504, whatever you have got. Then take the difference between these two numbers. Difference means 511 minus, again minus, because minus 20 to 180, minus will become plus. So the gap that gets created because of change in discount rate is the 511 plus 22, 180. Is it right? Change in NPV. Denominator is change in NPV into change in discount rate. change in discount rate is 11 minus 10. Okay. NPV at lower rate upon the change in NPV into change in discount rate. So this will give you 10 point some 23%. 0.023. Okay, no problem. This is called effective rate. Okay, this is what you are actually earning on this instrument if it is an asset for you, and this is what you are paying for this instrument if you are borrower. Is it right? So this is what we are earning. Now the question is debenture account. You have issued the debenture. Is it right? So actually this question is from issuer's point of view. So it becomes a liability. Doesn't matter. For the investor, you just do the reverse calculation, reverse presentation. Okay. So first I will show you how the entity which has issued the debenture will pass the entry, and then below this we will also pass the entry how the investor will record. Same thing, debit side will become credit side and credit side will become debit side. Ready? Write down in your books. In the books of issuer, debenture account, financial liability. We are just moving from our regular topic financial asset for understanding amortized cost concept. Doesn't matter. If it is an asset, the entries will be on the opposite side. So write in bracket financial liability. In the books of issuer, this is the format I am going to follow. You just help me. When was this bond issued? Any date given? So we will write year 1. Year 1. By bank. By bank, write 9 lakh. Why 9 lakh? Why not 10 lakh? Issued at a discount. So how much you received? 9 lakh only. What about that entry for discount on issue of debenture? That we will not pass. That has already got adjusted in this. That account will not get created in this chapter. Okay. Is it right? Then we will pass entry for interest accrued. Interest accrued entry. Interest account debit to debenture account. So amount will be opening balance, this figure, into effective interest rate. Anybody? Effective interest rate was 10.023%. Okay, round off while doing the calculation the last digit. 9 lakh into 10.023%. 9020. Otherwise it will not tally at the end. And then you have made payment. Debenture account to bank. How much will you pay? 60,000. So payment entry will be debenture to bank. And then please calculate balance carried down. This is a fundamental question for understanding how the amortized cost will work. Take credit side total minus debit side. Bolo 9 lakh. Tell me 9 lakh 30,000. Very good. By balance brought down, year 2 write down 930207. Now the interest will be 930207 into 10.023% by interest. This is effective interest. This is effectively you are incurring this much cost. If you are using funds of 9 lakh, you are incurring 90,207. If you are using more funds, 930207, you will incur more interest. How much is that? 93,235. This is what we incurred. And to bank write down 60,000. To bank write down 60,000. Payment made. coupon payment made, and tell me to balance carried down. 963442. Okay. Buy balance brought down 963442. Now just wait a minute. What is the total maturity period? 3. This is last year. So first you write down to bank 10,60,000. Why 10,60,000? 60,000 will be the coupon and 10 lakh will be redemption value. So this calculation now by interest will be your balancing figure. How much? 9655. Now if you see, this is not exactly matching with 963442 into 10.023%, but the difference will be very small. Just take your calculator, 963442 into 10.023%, 96565, and we are getting 96558. The difference is because this 10.023% is not an exact answer. It is approximately right answer, but still it is not accurate, 100% accurate answer. Okay, because somewhere we have rounded off in 3 digits, right? So some difference will come, don't bother, close it. Answer is over. In the books of investor, homework, write homework in the books of investor. This year, what you have written on the credit side, in the books of investor, write on the debit side. And what you have written on this debit side, you write on the credit side. Will you be able to do? Yes, I could not hear. Yes or no? Yes. Oh, that's better. Now we'll make some more variables in this. Question number 13. On 1st January 20x5, NTTA purchases a bond in the market for 53,993 rupees. Now this is an investment in bond. The bond has a principal amount of 50,000 and will be repaid on 31st December 20x9. What is the maturity period of the bond? 5 years. 5 years. Yes. It is 1st January. It is 31st December. So both we will count. The bond has a stated rate of 10%. Payable annually. So this is coupon rate. This is what you will receive. And the quoted market interest rate for the bond is 8%. Say thank you. Why? IRR is 8%. As a homework, you can check whether IRR is 8% or not. Yes, you can try. Okay. But in the exam hall, you don't try. Whatever is given, you take it and solve the problem. Rough idea I can give you why it is right. This time the bond is issued at a premium. So your effective cost to the company will fall. So it should be less than 10. It should be slightly less than 10, and that is what is 8%. But yes, if you cross check also, then also it comes to 8%. Approximately 8% you'll get. Now first question for 100 marks. Indicate whether the bond was acquired at a premium or at a discount. 100 marks. Premium. Right there, premium. Premium word tick mark. Prepare an amortization schedule. Amortization schedule means you will show opening balance, interest earned, interest received, and closing balance. That is called amortization schedule. So if they specifically ask you this, then first you have to prepare a table for 5 years showing opening balance, interest earned, interest received, and closing balance. That shows the amortized cost of the bond at the end of each year between 2005 to 2009 and the reported interest income in each period. That in any case I am going to calculate while preparing the amortization schedule, reported interest income. And then there is one more question, journalize. So you have to pass journal entries. How will you account for this instrument? In the books of NTTA, which is the investor entity. So see the amortization schedule. This is one format, and then I will show you one more format. Whichever one you want to follow, you can follow in the exam. Both are allowed. Understand the format. Then we will do the calculation part. Amortized cost at the beginning. Interest received. Received will be at 10%, which is a fixed number. 50,000 into 10%. Interest income recognized 8%, which will be effective interest rate into opening amortized cost balance. The difference between the two, 3 and 4, will be adjusted in the carrying amount of the investment and will give me amortized cost at the end. You can remove this column also. You can directly get this last column by taking 2, then plus 4 minus 3. 2 plus 4 minus 3 will also give you the closing balance. What extra you have done, you have just first taken the difference here and then you have adjusted in the opening balance. It is the same thing. Is it right? Same or different? Okay, so from where we will start this number? What will be the first number here? 50,000 or 53,993? Yes, your starting point will be 53,993. And what will be the closing balance after 5 years without solving? It should be 50,000 because 50,000 is the redemption value. So we'll check. Now interest at 10% will be always on face value. So just one calculation, right? 50,000 into 10%. 50,000 into 10%, write 5 times. Right? And block this column. But interest earned will change. You will take this number into 8%. Into 8%. Effectively, you are earning 8% on your investment because you bought this bond at a higher than the face value. So how much is that? Round off the last digit. 4319. Round off the last digit. Don't write in points. What is the difference? 681. So your closing balance will be minus 681 from the opening balance. 53,312. And you'll find slowly and slowly it will move towards 50,000. Then 53,312 into 8%. 4265. 735. 577. Wow, wonderful. Then into 8%. 4206. Difference. Okay. 51783. Very good. 51783 into 8%. 4143. 857. Wait, 50926. Is it right? Last year we will make a small change. Last year, first I will write here 50,000 because my closing balance should be equal to redemption value. To get 50,000, I need to deduct 926 from the opening balance. And to get this 926, this interest will become the balancing figure. 4074. And if you do the calculation also at 8% on this number, tell me 8% of 50926 is same 4074, which means 8% is your effective interest rate. Right? Otherwise, some difference may come and then you can treat this as a balancing figure. In this question, calculation also gives me the same amount. Now you write down journal entries. Year 1 entry I will give you, and then year 2, 3, 4 and 5. homework. You'll be able to do as you have been always doing. Right. So first you write down date, particulars, debit, credit. 1st January 2005. Investment in bond. Investment in bond account debit. Investment in bond account debit. 53993. Is it there? 53993. To bank account. To bank account. 53993. Basic entry for purchase of investment. And this is already fair value. So no adjustment required. Now directly come to 31st December 20x5. 31st December will pass entry for interest earned. What is the entry you will pass? Investment in bond account debit to interest income. Investment in bond account debit to interest income. This is your effective earning. Written investment in bond account debit to interest income account 4319. 4319. Same day continue. Bank account debit. Bank account debit 5,000. This 5,000. To investment in bond account. To investment in bond account 5,000. Interest received, or you can say cash flow received from this bond. Okay, they are calling it interest, but for accounting purpose it is a cash flow I have got back on this bond. So interest received on the bond. And one more entry write down on the same date, 31st December 20x5. Interest income account debit 4319. In your second entry you have created interest income account. Interest income account debit to profit and loss account. Interest income account to P&L account. Which figure you will transfer? 4319. That is your effective interest earned. Is it right? So this method says when you have more balance outstanding, you charge more interest. You get more interest in P&L account, and as your balance is reducing, you are recognizing less interest in the income statement. Is it right? If I follow this method, then what will be the problem? Every year I am going to recognize 5,000. Every year I am going to recognize 5,000, and in the last year what problem will happen? My book value will remain 53,993 and my redemption receipt will be 50,000, and I am going to show a loss. I am going to show a why? Because my book value is more and my amount received is less. So last year my income will suddenly go down. Is it right? Say for example, if I draw the graph under old system, historical system which they teach in school level accounting, under the traditional accounting system which is taught in school, colleges, BCom, MCom, Pune University, PhD course also, 5,000 rupees first year, 5,000 second year, 5,000 third year, 5,000 fourth year, and fifth year will be a small income, 5,000 income and loss of 3,993. So 5,000 minus 3,993 is how much? 1,007. So 5,000, 5,000, 5,000, 5,000 and 1,007. Now what is the need to show such a lower amount of income in the fifth year? Is there any valid reason? No. But if I follow this method which is on the screen, effective interest rate, first year I will show an income of 4319. then 4265, because my outstanding balance is reducing. See, the logically, as my balance is lower, I am recognizing less income. Less income. So this is your EIR. This is your traditional system. So from the diagram you must have understood that we have been taught wrongly for so many decades. Okay. Journal entry 4 years, you will do homework. But remember, in the last year, you have to pass one more entry. Bank account debit to investment in bond 50,000. Is it right? Last year you will pass one more entry, bank to investment. If they ask you for all 5 years, this way you will do. One more question we will practice on this. 14 number. Little fast this time. Everybody ready? On 1st January 2005, NTTA purchases a bond in the market for rupees 93,400. Bond has a principal amount of 1 lakh. That will be repaid on 31st December 2009. Again, same problem. After 5 year, bond has a stated rate of 6% payable annually, and the quoted market interest rate for the bond is 7.64%. That is the EIR or IRR. Don't check. Check it as homework. You will find that it is almost 7.64%. Only keep in mind, if the bond is issued at a discount, the effective rate will be higher than coupon rate. And if the bond is issued at a premium, the effective rate will be lower than the coupon rate, assuming no other cash flows. Assuming no other cash flows like some cash bonus, some redemption premium, etc. Then question for 100 marks. Indicate whether the bond was acquired at a premium or at a discount. Discount, tick mark discount. Prepare an amortization schedule. Okay, so same problem, only my purpose is, if it is discount, what will happen? Okay, so format you have understood. Start. What will be the starting number? 93,400. Yes, this is what we invested. Interest you will get as cash flow every year, 6,000. So what should be my closing balance after 5 years? 1 lakh. These are the numbers which we have logged. Now do the basic calculation. 7.64% of 93,400. 7136. So this time the difference is 1136. You will add or deduct now? Add. 94536. See, one more trick to know whether you have to add or deduct. I have to move from 93,400 to 1 lakh. So only by adding every year the difference, you will move to 1 lakh rupees. But don't remember like this, that is just a trick. What you have to know, this amount I am going to add, this amount I am going to deduct in the investment account. So what I am going to add is more than what I am going to deduct, and hence the balance will keep on increasing every year. Second year try. 94536. 722. 7222. 1222. 95758 into 7.64%. 7316. Amazing, Add 97074. Very good. 7416. 1416. 98491 approximately. 98491. Wait, reverse working. First you write here what amount you require to get 1 lakh. 1509. So this will become 7509 balancing figure. Okay. Cross check also whether you are getting same number. 98491 into 7.64%. 7525. Okay, that much difference is okay. So it seems this is EIR they have correctly calculated. Otherwise, I have told you how to calculate. Now I'm going to give you a shortcut formula for EIR, but that you will apply only for a coupon paying bond. Only for a coupon paying bond means a bond which pays coupon for a given number of period and then it is redeemed on maturity. No other inflow outflow. Okay, no other pattern of cash movement. Like this only. So write one direct formula for EIR in the exam because IRR method is lengthy. C plus RV minus CP upon N upon RV plus CP upon 2. This is the formula for cost of capital in case of debenture. This is the formula for YTM in case of a bond. Is it right? So C means coupon. In our example, it is 6,000. Redemption value is 1 lakh in this example. CP means current price. Current price in this question is 93,400. Right somewhere this is fast and you will not go wrong and it is acceptable in the exam also. N means number of years. Divide by 1 lakh plus 93,400. This is taught in basic financial management subject. Okay. But it will work only for a question like this where there is a periodic coupon payment and redemption only on maturity. If it is a zero coupon bond, bonds which are paid in installments, perpetual bond, this will not work. For that, then other formula. Anybody is able to solve it? 7 point? So 57% approximately, because this is a formula method. So it will give you approximate answer. And they might have calculated using the computer. Is it right? In computer, you write down the numbers, put the formula, and you'll get exact answer, accurate answer. Okay. Journal entries. Write down. Year 1 I will dictate. Year 2, 3, 4, 5 homework. And in the 5th year you will pass one more extra entry. Redemption entry, bank to investment. Bank to investment. In the exam they have asked both type of problem. Journal entries also, ledger account also. So in the next question I am also going to prepare the ledger accounts. Okay. So first write down date particulars, debit credit. Date 1st January 20x5. Investment in bond account debit 93,400. Investment in bond account debit 93,400 to bank account 93,400. Narration purchase of investment. And then you will go to 31st December 20x5. Interest earned entry. Investment in bond account debit 7136. 7136. 2. Interest income account. To interest income account 7136. Same date. Bank account debit to investment in bond account 6,000. So you can understand from these two entries your net addition in the bond account is 1136. Yes or no? First you debited 1136. Now you have credited 6,000. So your bond value will go up by 1136. One more entry. interest income account debit to profit and loss account. Which number you will transfer? 7136. 7136. In the second year, third year, fourth year, you will repeat entry number 2, 3 and 4. Not all 4. Every year don't pass entry for purchase. I said you repeat the entry does not mean you will repeat investment to bank 93,400 every year. That is only in year 1. In year 5, repeat entry number 2, 3, 4 and a fifth entry, that is your bank to investment 1 lakh. Is it right? So journal entry for year 2, 3, 4, I am sure you'll be able to do. Now, in this chapter, we will also discuss one special case called staff advances. Although standard does not specifically talk about it, but the examiner has asked question on this. Okay. So many companies, what they do, they give advance and loan to their employee. So it's a financial asset, contractual right to receive cash flow from the employee in the form of interest and principal. But in order to give incentive to the employee, as a reward to the employee, as a compensation for the services rendered by the employee, they charge them very high rate of interest. True or false? False. I was checking whether you are awake or not. They charge low rate of interest. Sometimes zero rate of interest also. Okay. Now the standard says, while doing accounting, calculate the fair value of the loan given to staff, which will be present value of future cash flow discounted at market rate of interest. But then if you do the market rate of interest, the present value will be much lower than the amount of loan actually given, because the loan is given at 2%. Market rate is 12%. So what about that loss? That loss is nothing but a form of employee compensation expense. So we'll treat it as employee compensation expense. And if the employee has served whatever vesting condition were required, then it will be immediately charged to P&L account. But if the employee is required to serve some conditions, fulfill some conditions, then it will be deferred and written off over the period in which he has to complete those conditions. Right? So what you will do in the exam? You preferably charge it to profit and loss account. This is what the suggested answer also does. So what will you do when employees are given the loan at concessional rate of interest? Then only you apply this entire concept. If they are given loan at a market rate of interest, then there is no problem. Staff advances will be dealt with as follows. Step 1, you identify cash flow arising out of contract. As usual, cash flow will be in two forms, interest and redemption. Then discount such cash flows at effective interest rate, which will be management's estimate, means market rate. And then value the value of staff advance to be shown as an asset. That means the fair value of the loan will be present value of cash flow calculated in step number 2. And then the difference between the amount actually given as loan to the staff and the fair value of the loan calculated above will be treated as staff cost or employee benefit expense. Is it right? And then the treatment of staff cost will be, you either write it off over the vesting period as per the contract, or you can recognize it immediately if there is no vesting period. That means no further conditions have to be satisfied. You treat it as a cost of that year. First year only you will write it off. Okay. So this again brings us the concept of substance over form. So traditional accounting will change here. Now I am not going to recognize 2% interest income. I am going to recognize effective interest rate into the fair value of the loan given as interest income. Because in the name of loan, you are actually giving compensation to the employee. Why otherwise will you charge a low rate of interest to employee? It is a reward for rendering the service. Reward for rendering the service means you can say it's like a benefit given to the employee. So that benefit to be shown as employee cost, not as a finance cost. Is it right? It's a form of benefit he is giving to you, company. So that should be accounted as employee benefit cost. A popular question in the exam comes like this. C Limited granted rupees 10 lakh loan to its employee on 1st January 2009 at a concessional rate of 4%. Loan is to be paid in 5 equal installment. 5 equal installment along with interest. So the wording of the question is 5 equal installment along with interest means this will be divided by 5 and plus interest will be paid on outstanding balance. See, they can change the question like this also. The loan will be paid in 5 equated installment. Suppose they change it, 5 equated installment consisting of principal and interest. Then it has a different meaning. Then in that case, this loan 10 lakh will be first divided by present value annuity factor 4% 5 year to get the equated installment amount. Is it right? Like you do the in SFM equated installment, and then your answer will move accordingly. Is it right? So drafting of the question is simple. 5 equal installment along with interest, or equated installment consisting of principal and interest will have a different meaning here. Market rate is 10. This is discount rate. Record the entries for the year ended 31st December 2009. Means only first year they want you to pass the entry. If they ask you only 1 year, no need to write 5 years. No extra mark for writing extra 4 years. Okay. And also calculate the value of the loan initially to be recognized, which is the present value of future cash flow, and amortized cost for all the subsequent year. Amortization schedule again you have to draw. To help you, they have given you present value factor at 10%. And I have added one more question from my side. Prepare staff loan account. Journal entry they had asked. Last third point I have added. Prepare staff loan account for 5 years. So I am going to prepare ledger account also. Is it right? Journal entry they have asked only for 1 year. So what the student will do? First you compute the fair value of the loan amount today. Haji? Calculate. Fair value of the loan will be present value of future cash flow discounted at 10%. Is it right? This basic question you should be able to solve. Then come to format year, principal repayment, right? Principal repayment. How much amount he'll repay every year? 2 lakh. So you write 2 lakh 5 times. Interest at 4%. Will interest be constant or diminishing? It will reduce because every year 2 lakh you are repaying. Total cash flow will be this interest plus principal. Factor copy from the question book preferably given in the question and multiply. Do this task yourself. I will help you with principal column. 2 lakh 5 times. And then interest will be, first year interest will be 4% of 2 lakh or 8 lakh or 10 lakh. I am getting two different voices. 4% of 2 lakh or 8 lakh or 10 lakh? 10 lakh. 10 lakh. At the end of the year, 2 lakh will be redeemed. So for the entire year, 10 lakh was outstanding. So 10 lakh into 4%. 10 lakh into 4%, 40,000. Then 8 lakh into 4%. 32,000. 6 lakh into 4%, 24,000. 4 lakh into 4%, 2 lakh into 4%, 8,000. Now take total. Without calculator, try today. 2 lakh plus 40,000. 2 lakh 40,000, 2 lakh 32,000, 2 lakh 24,000, 2 lakh 16,000, 2 lakh 8,000. Apply the factor given in the question. These are the factors given in the problem. Multiply, take total. Use calculator, equal to memory plus, equal to memory plus. So you are automatically going to take the total of the last column. Who got the total of last column? Is it something like 8,54,763? Since we are using same factor, same cash flow, same answer. Eight mark question. Very easy, bonus marks. So assuming you have done 854,763, now you prepare the amortization schedule. Those who have done, others will complete it fast. Amortization schedule. Understand the table. First column year, amortized cost opening balance, interest to be recognized, this you add, repayment including interest. Now here there are two types of repayment, principal and interest. So I am going to write both numbers. Like in first year 2,40,000 I had redeemed, and then closing balance 2 plus 3 minus 4. So if you follow this format, it is good. Only 5 columns will be required. Is it right? So format I have drawn to save your time. And now you write year column 9, 10, 11, 12, 13. You will start with which number? First working note number. First working note number 854,763. This was your opening balance. 10% calculation is easy. Don't use calculator. Write 85476. And this repayment column will be from again first working note. First working note, column number 4, 2,40,000. Closing balance you have to calculate. Is it 7,00239? Check. Second year, this will become opening balance. On that 10%, 2,32,000. Check the balance. 538,263. Try the third year yourself. Third year. Very easy. Come on. 368,089. Check. If it is wrong, tell me. Fourth year, closing balance 1,888,98 plus minus 1 or 2 rupees is okay. Last year should be 0. Last year should be 0. And in last year, what you do, you adjust the interest as a balancing figure. Okay? Because after paying this 5th installment, the balance would become 0. After paying the 5th installment, the balance will become 0. Okay? So interest you adjust slightly over here. Now see the journal entries. First we are going to pass the entry staff loan account debit to bank 10 lakh 10 lakh. Write down in the journal entry below staff loan account debit to bank 10 lakh. But then I realized no, this 10 lakh is wrong. Only 854,763 is the fair value of the loan. So then what I will do? The difference I will transfer to staff cost account. You can give any other name, employee benefit expense. Staff cost account debit 145,237 to staff loan 145,237. So the effective of this entry is your staff loan will now appear at 854,763. Suppose you want to pass only one entry, you can do that, no problem. Staff loan account debit 854,763, staff cost account debit 145,237, and to bank account 10 lakh, doesn't matter. Both are welcome. Then you pass entry for interest income earned. Interest income earned will be based on effective interest. Staff loan account debit 85476 to interest on staff loan 85476. Okay. And then you receive the cash flow. Cash flow entry bank account debit to staff loan 2,40,000. So exactly what you are doing in that amortization schedule is happening here in the form of journal entries. And then this interest that you have earned on staff loan, you recognize in profit and loss account. Interest on staff loan account debit to P&L account. It's an income, but this 145,237 staff cost is an expense. So P&L account debit to staff cost 145,237. Okay. Assumption right. It is assumed that the staff cost will vest immediately. It is assumed that the staff cost will vest immediately. VEST. Okay, best nahi. Staff cost will vest immediately. So that is why we have transferred it to P&L account. This assumption can be written in the exam. The answer is not over. You have to also prepare the staff loan account. Write down below. No, right now. I have already given you enough homework. Journal entries for 2 questions I have given. Investment account in the books of investor I have given in one problem. When will you sleep today after doing so much homework? But good students will do. Chance taker students will not do. Now write. First entry, year 1 to bank 10 lakh. This was my first entry. Staff loan to bank. My second entry was staff cost to staff loan 145,237. By staff cost 145,237. Then I will pass entry for interest earned using effective interest rate. So can you just tell me how much was that amount? 85. Yes, and by bank 2,40,000. This is the amount received. By balance carried down. Either you calculate it or it will appear in that amortization schedule also. Last column. How much is that? 700,239. Is it right? Now repeat 700,239. Keep that amortization table where you will get the interest calculation also. 700,24. By bank year 2. Was it 2,32,000? You don't have to use calculator. This everything is appearing in that amortization table. And by balance carried down second year closing balance. By balance carried down second year closing balance. 5 lakh 38,263. Third year, 2 balance brought down. 538 to 63. 2 interest was how much? 538 to 6, correct? And buy bank was how much in the third year? Buy bank 2,24,000. Buy bank, buy balance carried down 3,68,089. Everything is there in your amortization table. 368089, 36809, right? Buy bank is 2,16,000. Year 4. Buy balance carried down 1,88,000. Okay. 188,898. And 2 interest balancing figure was how much? 19. And buy bank was how much? Year 5. Okay. If they ask you to prepare the loan account for 5 year, this way you have to prepare. See, we have to think beyond the notes of the institute. They will not give everything in the notes. Something they will reserve for exam also. So now we'll take a small break and we will continue after the break.